So usually when we look at, the underlying logic of a modern growth strategy, there is this pervasive, almost unquestioned assumption that bigger is just inherently better.
Right, it's the classic American business mindset.
Exactly. Especially in this era of hyper-scaling. You want more customers, you want more top-line revenue, and you are basically willing to bleed cash just to capture a fraction of a percent more in market share.
It's a volume game. Pure and simple.
Yeah, it is. It feels a lot like walking into a restaurant and judging its culinary success purely by the sheer tonnage of food being shoveled onto plates.
Like a cheap, all-you-can-eat buffet.
Right. The goal at the buffet is just to get as many people through the door swiping their credit cards as humanly possible.
Regardless of the massive amount of waste generated in the kitchen.
Exactly.
And I mean, the metric of success in that model becomes foot traffic rather than actual culinary quality.
Or, net profit per plate.
Which is the most important thing for a business. You see this everywhere in the broader market today. User acquisition costs are completely ignored as long as the user base itself is trending upward on a chart.
It's all about the graph going up and to the right. But then you look at a company that actively, deliberately decides to serve fewer people.
Which is so rare.
It really is. They evaluate their business model and intentionally let their customer base shrink. They literally watch people walk out the door and do not try to stop them.
Right, they just let them go.
And when you encounter that, you have to stop and ask yourself, are we looking at a company that is finally skipping the low-margin, high-stress buffet to order one really good, perfectly cooked, highly profitable steak?
That's a great way to frame it.
Well, today we are going to see if this particular diet is actually working. So welcome everyone to this Talk Tickers Deep Dive.
Glad to be here.
We are going to spend this session tearing a specific earnings report down to the studs. Our mission today is to provide a really rigorous data-forward analysis of Erie Indemnity's Q2 2026 earnings, tailored specifically for you, the retail investor.
And we're ditching the Wall Street jargon today.
Oh, absolutely. We are going to translate all the complex actuarial mechanics into plain language, and we'll give you a highly actionable, opinionated verdict by the end of this conversation.
I think the overarching theme of the source material we're evaluating today, which is the Q2 2026 earnings call and the financial releases for Erie Indemnity, is just fascinating.
For those following along, that trades under the ticker symbol E, right?
Correct, ERE.
Yeah.
And it presents a really fascinating case study in management discipline. This is a company actively navigating one of the oldest business dilemmas in existence.
The classic growth versus profit struggle.
Exactly. They are systematically sacrificing sheer growth volume in favor of much-needed structural profitability.
And to see if the strategy of choosing margin over volume is actually paying off, we need to dive straight into the headline numbers from the Q2 release.
Let's do it.
Let's start with the bottom line profits because, that is the ultimate scorecard, right?
Right? Always.
So for the second quarter of 2026, Erie's net income hit $180 million.
Which is a solid number.
It is. When you run that through the outstanding shares, it breaks down to $3.45 per diluted share.
And the baseline context for those figures shows clear, undeniable expansion. Because if you look at the same period last year, Q2 of 2025, they posted $175 million in net income.
Right, so it went up.
Yeah, up from $3.34 per share.
Yeah.
So the immediate takeaway from the hard data is that the bottom line is growing. The profit engine is generating more cash.
And operating income tells a very similar story. It grew 2.5% to $204 million, up from $199 million in Q2 of 2025.
But before we dig deeper into those percentages, we really need to establish exactly how Erie Indemnity makes this money.
Yeah, because they are not structured like a standard run-of-the-mill auto insurer.
Not at all. Understanding their specific corporate structure is critical for anyone evaluating the stock. Erie Indemnity is actually a management company.
Right. They operate as the managing attorney, in fact, for the Erie Insurance Exchange.
Exactly. The exchange itself is a reciprocal insurer, meaning it is technically owned by the policyholders.
So wait, the people buying the car insurance actually own the pool of risk?
Correct. But obviously, those policyholders do not run the daily operations. They hire Erie Indemnity to do the heavy lifting.
The paperwork, the underwriting, all of that.
Yeah, issuing policies, handling the underwriting process, managing customer service, sending out renewals. And for providing all of those essential administrative services, Erie Indemnity charges a management fee.
And that fee is based on the volume of direct written premiums at the exchange, right?
Exactly. So a primary driver of revenue for the stock you buy, Erie, is that management fee revenue. And for this quarter, that fee revenue grew 4.7% to $39 million.
Okay, so they collect fees for shuffling the paperwork and managing the risk pool. But they also have a massive pile of capital sitting around that they need to do something with, which brings us to investment income.
Oh, the concept of the float. This is where insurance companies generate a massive portion of their wealth.
It's the Warren Buffett secret sauce.
It really is. When you pay your auto insurance premium in January, but you don't get into a fender bender until October, the insurance company gets to hold on to your cash for 10 months.
And when you multiply that by millions of customers, you have billions of dollars in liquid capital.
Exactly. And they don't just stuff that cash in a corporate mattress. They invest it, typically in highly secure, yield-generating assets like corporate and government bonds.
And because interest rates have completely reshaped the bond market over the last few years, the yield on that massive pool of float has become a serious profit center.
The numbers definitely reflect that. Investment income for Erie grew to $23 million in Q2, which is up from $20 million in the same quarter last year.
And if you zoom out and look at the first 6 months of the year, investment income totaled $45 million compared to $39 million in the first half of 2025.
So just to summarize the top line, the management fees are growing, the investment yields are growing, and the net income is up. The financial foundation is undeniably solid.
Okay, I hear you. But I want to introduce a dose of skepticism here because context is everything.
Fair enough.
I am looking at a 2.5% growth in operating income and a 4.7% growth in management fees. Let's be entirely honest about the market environment we are operating in right now.
It's aggressive out there.
It's crazy. We are surrounded by artificial intelligence hyperscaling where tech companies are routinely posting double-digit, sometimes triple-digit revenue growth.
Yeah.
Retail investors are constantly bombarded with stories of companies doubling their market cap in a matter of months. So in that specific context, why should an investor get excited about a 2.5% bump in operating income? It feels almost, glacial.
It does feel glacial if you are evaluating the entire stock market through the lens of a Silicon Valley venture capitalist.
Right.
But portfolio construction requires different assets to perform different roles. You do not buy an insurance indemnity company expecting it to disrupt a global paradigm and scale to the moon overnight.
You buy it for defensive stability.
Exactly. Over the last 3 years, the insurance sector has faced immense macroeconomic pressure. We're talking runaway inflation on auto parts, skyrocketing labor costs at body shops, and severe medical inflation for bodily injury claims.
It's been a bloodbath for insurers.
It really has. In that hostile environment, merely surviving is an achievement. Posting slow, steady, positive growth while navigating those headwinds is the absolute gold standard for a defensive stock.
It is the financial equivalent of a reinforced concrete bunker. You don't buy a bunker because it goes fast. You buy it because it doesn't break when the storm hits.
I love that analogy. And this particular bunker has an incredibly well-capitalized balance sheet. That steady single-digit growth we just outlined is backed by such fundamental financial strength that Erie was able to pay out $136 million in dividends to shareholders in just the first 6 months of 2026.
Wow, $136 million in 6 months.
Yeah. A hypergrowth tech company is usually burning cash to acquire users, meaning they have to constantly dilute shareholders or take on debt to survive. Erie is generating so much excess stable cash flow that they can literally hand $136 million back to the people holding the stock, rain or shine.
The dividend really is the ultimate proof of life for a defensive asset. You cannot fake cash flowing into a brokerage account.
Exactly.
But to truly understand why posting any kind of profit this quarter represents a massive, almost improbable operational win for management, we have to look closely at the story behind the numbers.
Because the numbers only tell part of the story.
Right. Because you mentioned the phrase rain or shine, and in Q2, Erie faced an unprecedented amount of rain.
Literally.
Literally. But before we detail the physical storms, let's establish the metric we are using to measure the damage.
Any retail investor looking at the insurance sector needs to intimately understand one specific metric, and that's the combined ratio. It is the absolute defining gauge of an insurance company's core operational health.
Okay, let's translate this out of actuary speak. How does a combined ratio actually work in practice?
It is effectively a measure of profitability that focuses entirely on the daily operations of writing insurance, completely ignoring the investment income we talked about earlier.
So we put the bond yields aside for a minute.
Right. It just compares the money going out the door to the money coming in the door. You calculate it by adding together two things: the incurred losses, which is the money paid out to customers filing claims, and the operating expenses, like paying agents, running the software, keeping the lights on.
Makes sense.
You take the sum of those losses and expenses, and you divide it by the earned premiums collected from customers.
It is a simple fraction. Money out over money in.
Exactly. The baseline you are looking for there is 100. If the combined ratio is exactly 100%, the company is perfectly breaking even on its underwriting.
They take in $1 in premiums and pay out exactly $1 in claims and administrative costs.
Yes. If the ratio is under 100%, say 95%, they are generating an underwriting profit. They are keeping 5 cents of every premium dollar before they even touch their investment portfolio.
But if it is over 100%, they are upside down.
They're upside down.
They are paying out more in claims and expenses than they are collecting in premiums. They are actively bleeding cash on the actual business of writing insurance, and they have to rely on their investment income just to plug the hole in the boat.
That's the danger zone.
Yeah.
And looking at Erie's performance for this specific quarter, their combined ratio landed at 103.9%.
Okay, wait. By the definition we just established, anything over 100 is a loss. So at 103.9%, they are still technically operating at an underwriting loss.
They are. The core insurance business operated at a deficit for the quarter.
Okay.
But the reason this earnings report is turning heads is the year-over-year comparison. That 103.9% combined ratio is a 13-point improvement from the catastrophic 116.9% combined ratio they posted in Q2 of 2025.
A 13-point swing in a single 12-month period is genuinely staggering.
It's massive.
I mean, when you are dealing with billions of dollars in premium revenue and hundreds of thousands of individual risk profiles, improving your margin by 13 percentage points is a monumental structural shift.
The underlying performance improvement is huge, especially when you factor in the external environment they were operating in during those 3 months.
This is where the narrative in the source material presents a massive glaring contradiction that we really need to resolve.
Oh, the weather data.
Yeah. During this earnings call, management stated on the record that in Q2, Erie faced the costliest weather event in company history.
Not just a bad storm.
No. The absolute worst string of catastrophic weather events the company has ever had to finance since it was founded.
The physical devastation across their geographic footprint was unprecedented. We're talking severe convective storms, hail, and wind that absolutely battered their policyholders.
And management noted that these catastrophe losses alone hit their combined ratio by 15 points.
15 whole points.
So let's walk through the math here, because it's wild. You take a 15-point direct hit to your profitability metric from historic, record-breaking weather damage, and yet your overall ratio somehow improves by 13 points year over year.
On paper, that should be impossible.
A 15-point catastrophic headwind should have driven their combined ratio well into the 120s. How on earth did they absorb the worst storm in company history and still come out 13 points ahead of last year?
The math only reconciles because management completely overhauled the fundamental architecture of their risk pool over the preceding 12 months.
The pivot.
Exactly. They survived the 15-point weather hit and still posted a massive overall improvement because they executed the profitability pivot we discussed at the top of the show. They made incredibly difficult, deliberate choices about who they were willing to insure and what they were going to charge them.
Walk me through the mechanics of that pivot. How did they actually re-engineer the business to be that resilient?
The transformation is visible right in the premium data. Direct written premium growth, the total volume of new money coming in, slowed down to 3.3% in the second quarter.
And what was that growth rate previously?
Well, in the second quarter of last year, direct written premium growth was humming along at 9.2%.
Oh, wow. So top line premium growth experienced a massive deceleration and they pumped the brakes hard.
Really hard. But the critical piece of the puzzle is why the growth slowed down. It wasn't because their marketing failed or their agents stopped working. It slowed down because Erie's management raised the average premium per policy by 6.8%.
They looked at the inflationary environment and just jacked up the prices across the board.
They refer to it internally as pursuing pricing adequacy.
I love that corporate spin, pricing adequacy.
Right. But it's true. Over the last few years, the cost of repairing a vehicle has skyrocketed. A bumper used to be a piece of plastic. Now it is a housing unit for 6 microchips, a radar array, and 3 cameras.
Seriously. When someone backs into a pole, a $400 repair is now a $3,500 recalibration process.
Add in the rising costs of medical care for bodily injuries, and the surging prices of lumber and roofing materials for home insurance, and the legacy premiums Erie was charging simply were not mathematically sufficient to cover the modern risk. They were underpricing their product. So they instituted a near 7% rate hike.
And human nature dictates that when you raise a customer's auto insurance bill by almost 7%, they immediately go online and start shopping around for a cheaper rate.
Of course. And management anticipated exactly that behavioral response. They knew the rate hikes would trigger customer churn. And the data shows it happened. Policies in force dropped by 2%.
2% of their total customers.
Nice. Furthermore, their retention ratio, which measures the percentage of existing customers who choose to renew their policies at the end of their term, dips to 87.5%.
So they are intentionally shedding policyholders.
They are actively letting certain profiles walk out the door. If a customer is high risk or unwilling to pay the newly adjusted premium that accurately reflects the cost of repairing their vehicle in today's economy, Erie is perfectly content to let a competitor take on that guaranteed loss.
That is so bold.
It is. They deliberately shrank the total customer base by 2% to ensure that the remaining 98% are priced adequately for the actual modern risk they represent to the pool.
It feels less like pruning a tree and more like a nightclub that's getting way too crowded.
Okay, I like where this is going.
The floor is packed, people are bumping into each other, fights are breaking out, which in this analogy translates to car accidents and claims, and the whole operation is just becoming a liability.
Right.
So management raises the cover charge by 7%. A chunk of the rowdy, low-margin patrons complain about the price and leave to find a cheaper bar down the street. The volume inside the club drops by 2%, but suddenly the environment is stable, the bartenders can keep up, and the VIPs who stayed are happily paying the higher prices. Your top-line headcount is lower, but your profit margin per person skyrockets.
That structural shift is exactly why the combined ratio improved so dramatically despite the historic weather events. The underlying portfolio of insurance policies, the group of people remaining in the nightclub, is fundamentally healthier, more accurately priced, and more resilient than it was a year ago.
Because they got rid of the bad risks.
Exactly. We can see this in the non-catastrophe data. Losses, completely unrelated to the big weather events, actually improved by almost 3 points from last year. The day-to-day fender benders and kitchen fires are costing them less relative to the premiums they're taking in.
So when the historic storm finally hit, it crashed into a heavily fortified, accurately priced book of business rather than a bloated, underpriced whisk pool that would have completely buckled under the pressure.
You nailed it.
That breakdown perfectly illustrates why you cannot simply glance at a top-line revenue growth chart and understand a company's health. Sometimes intentionally shrinking your market share is the most lucrative, responsible decision a management team can make.
It takes a lot of discipline.
It really does. But the profitability pivot wasn't entirely driven by raising revenues on the remaining customers. I noticed a very interesting quirk on the other side of the ledger in how they manage their internal expenses.
Oh, you're talking about the non-commission expense line item. It tells a fantastic story about how accounting anomalies can obscure operational reality.
Let's look at the numbers. Non-commission expenses dropped by 4.8% year over year, which translates to roughly $9 million in hard savings during the second quarter.
$9 million.
Yeah. In a highly inflationary environment where employee salaries and software costs are universally rising, cutting internal expenses by nearly 5% is a massive win. But when you dig into the footnotes to see how they cut $9 million, a massive chunk of that savings materialized simply because they didn't have to throw a massive party this year.
Right. Specifically, they didn't have to pay out the 100th anniversary bonus.
It's so funny. Last year, in 2025, Erie celebrated its centennial. To mark 100 years in business, management issued a special one-time anniversary bonus to all their employees.
Which is a massive capital outlay.
Huge. This year, in 2026, there is obviously no 100th anniversary, therefore no massive special bonus. The absence of that one-time historical payout automatically makes this quarter's expense sheet look millions of dollars lighter compared to the same period last year.
It is almost comical how a single milestone event can completely distort a year-over-year financial comparison.
It really highlights a crucial discipline for retail investors. You must always normalize the data.
Always.
You have to strip out the one-time, non-recurring events, whether it's a centennial bonus, a massive legal settlement, or the sale of a real estate asset, to understand the true baseline run rate of the business. You cannot assume a 4.8% expense reduction is a permanent structural efficiency if half of it is just the absence of a birthday party.
Exactly. However, what makes this specific quarter impressive is that even after you normalize for the missing anniversary bonus, they still demonstrated real structural expense discipline.
Because they actually had to pay more in standard performance bonuses this year, didn't they?
Considerably more. Personnel costs tied directly to regular incentive compensation actually increased by roughly $3 million.
Because the company's baseline performance metrics, like the massive 13-point improvement in the combined ratio, triggered the performance accelerators for the employees. They hit their targets, so the bonus is paid out.
Exactly. So they absorbed a $3 million increase in performance compensation. And yet total non-commission expenses still went down.
That's incredible.
It means they genuinely tightened the belt in the structural day-to-day operations. The earnings report highlighted lower expenses in sales and advertising, reductions in acquisition and underwriting support costs, lower professional fees paid to outside consultants, and just a general tightening of administrative overhead.
They raised the cover charge at the nightclub, bounced the unprofitable patrons, absorbed the worst storm in company history, and simultaneously figured out how to spend less on advertising and administration.
They stabilized the ship.
They proved the diet works.
The defensive maneuver was flawlessly executed.
But, and I think this is the existential question for the stock moving forward, you cannot shrink your way to long-term greatness.
No, eventually you have to grow.
Right. You can trim the fat and prune the bad policies to survive a macroeconomic crisis, but eventually a publicly traded company has to start building muscle again. Defensive stability is great, but what is management's guidance for actual forward momentum? How do they plan to pivot back to growth now that the foundation is secure?
Management is acutely aware that the era of simply tightening the belt is reaching its natural limit. They laid out a very clear three-pronged approach to future growth.
Okay, let's hear it.
And what is most notable is that none of the three prongs rely on aggressive marketing or lowering prices to buy back the market share they just gave up.
That's refreshing.
Instead, their growth strategy is entirely focused on modernizing their operational machine to acquire better CFR customers.
Let's dissect these three initiatives. What is the first major lever they are pulling?
The first initiative is the continued rollout of a completely overhauled product offering called Erie Secure Auto. This represents a foundational modernization of their personal auto insurance line.
How widespread is this?
It is currently live and generating policies in 10 states. Most importantly, that footprint includes Pennsylvania, which went live in May and represents their absolute largest market by volume.
Now, to a layman, auto insurance is just auto insurance, you know. It's a piece of paper in your glove box that keeps you from getting arrested if you get pulled over. Why does rolling out a quote-unquote new auto product matter so fundamentally to their growth strategy?
Because the mechanism for calculating risk has fundamentally evolved. In the legacy insurance model, actuaries used incredibly broad strokes to determine what you should pay. They looked at your age, your gender, your zip code, and the make and model of your vehicle.
Pretty basic stuff.
Very basic. They grouped you into a massive cohort and applied a generalized rate based on the law of large numbers. But today, the market is defined by telematics and hypersegmentation. To compete against the massive national carriers, you cannot rely on broad demographics anymore.
You need to be more precise.
Exactly. You need sophisticated data models that can ingest microscopic differences in behavioral risk profiles and output highly flexible, individualized rates.
It is the difference between quoting someone based on the fact that they live in a specific city versus quoting them based on the fact that they specifically drive 14 miles a day, strictly between the hours of 9 a.m. and 4 p.m. on roads with low accident frequencies, and they never brake aggressively.
Erie Secure Auto provides the underlying technological infrastructure to execute that exact level of hyper-segmented pricing. It allows their underwriters to be incredibly aggressive and competitive when they identify a phenomenally safe driver they want to acquire, while simultaneously allowing them to quote defensively high rates to risky drivers they want to keep away.
It perfectly complements the strategy of only bringing on profitable policies. If your goal is to build a risk pool of the safest possible drivers, you cannot operate with a blunt instrument. Erie Secure Auto gives their independent agents the precision tools they need to surgically extract the best customers from the broader market.
And giving those independent agents better tools transitions us perfectly into the second prong of their growth strategy, which is a massive technological upgrade on the distribution side of the business.
The new online quoting platform.
Yes.
Management highlighted that this deployment was completed across their entire geographic footprint by the end of June. We promised to strip away the Wall Street jargon, so the plain language takeaway here for the retail investor is simple. The new system is an absolute home run.
The specific data point management provided regarding the new platform is staggering. Conversions have nearly doubled compared to the legacy online quoting system.
We need to pause and emphasize the magnitude of that achievement. Let's look at the mechanics of digital customer acquisition. You spend millions of dollars on marketing, search engine optimization, and brand awareness just to get a potential customer to land on your website and click the Get a Quote button.
That's the hard part.
Right. But in a legacy system, that customer then faces a 15-page questionnaire asking for their vehicle identification number, their driving history, their social security number. It is a very high-friction environment.
People hate it.
They despise it. And because of that friction, the vast majority of people abandon the process halfway through. If Erie has implemented a system that is so frictionless, so user-friendly, and so well integrated with third-party data sources that they have literally doubled the rate at which a browser turns into a buyer, that is a monumental operational victory.
By doubling the conversion rate, they have effectively cut their digital customer acquisition cost in half. They are getting twice the return on the same amount of top-of-funnel web traffic.
Furthermore, it fundamentally strengthens their distribution model. Because Erie does not employ thousands of direct salespeople, right? They rely on a vast network of independent insurance agents. The corporate entity generates the leads, but the local agent closes the deal and services the policy.
Yes. And if the corporate mothership can provide those local independent agents with a highly optimized, high-converting digital funnel, the agents make more money with less effort. It built incredible loyalty within the agency network.
An agent who represents 5 different insurance carriers is obviously going to prioritize the carrier whose digital tools actually work and deliver high-quality, pre-qualified leads.
Of course, the new platform meets the modern consumer's expectation for a seamless digital experience while simultaneously empowering the local agent.
Okay, so we have hyper-segmented pricing models with Erie Secure Auto, and we have a high-converting digital intake funnel slashing acquisition costs. What is the third prong of the growth strategy?
The third initiative is a targeted, highly creative program aimed at one of the most notoriously difficult demographics in the industry. It is a program called Team Smart, focused specifically on young drivers.
Reading the source material on this initiative was fascinating because it represents a brilliant application of behavioral economics.
It really is smart.
The program offers drivers under the age of 20 up to a 20% discount on their auto premiums, but it is not a blanket discount. It is entirely conditional. The teenagers have to earn it through action.
Erie actually partnered with a specialized firm called ADPT Driver to build the curriculum. To unlock that 20% savings, the young driver must complete a rigorous course of video learning modules, advanced driving simulations, and supervised in-car driving activities.
From a purely psychological and financial perspective, this is a masterpiece. Think about the consumer pain point here. For a family, adding a 16-year-old to the primary auto policy is an absolute financial nightmare.
It's so expensive.
Teenagers have terrible spatial awareness, high impulsivity, and zero experience behind the wheel. Actuarially speaking, they are guaranteed to crash, which means insuring them is famously prohibitively expensive. When a parent gets the bill for adding their teenager, they often experience severe sticker shock and immediately start looking for a cheaper carrier.
It is a massive point of churn for families who might otherwise be incredibly loyal, long-term customers.
So Erie approaches that stressed parent and says, look, we will knock a massive 20% off this terrifying bill, but your teenager has to pass this rigorous simulation and training course. It is a proposition no parent is going to refuse.
Never.
They are essentially forcing teenagers to play a high-stakes educational racing simulator to ensure they understand following distances and hazard recognition before they take the family sedan onto the highway. Parents are going to sign up for that in droves because it saves them money and makes their kids safer.
It acts as an incredible customer acquisition tool for young families, but more importantly, it functions as a powerful retention tool. Once a family is integrated into that ecosystem, they are highly unlikely to leave.
Right.
But the real brilliance of TeamSmart is that it is not just a marketing gimmick or a loss leader. Management provided qualitative data stating that the young drivers enrolled in the simulation program are demonstrating provable, statistically significant improvements in both claim frequency and claim severity compared to their untrained peers.
Wait, really? The behavioral modification actually works?
The data says yes. They get into fewer accidents, and because they are better at hazard recognition, the accidents they do get into occur at lower speeds and result in less physical damage.
The financial calculus for Erie is incredibly favorable then. Yes, they are sacrificing 20% in premium revenue on the front end by granting the discount, but they are saving exponentially more than that on the back end by avoiding massive bodily injury payouts and total loss vehicle replacements.
Exactly.
They are actively manufacturing a safer cohort of young riders, securing the loyalty of the parents, and growing the business with a demographic that other carriers struggle to manage profitably.
It is a textbook example of aligning the company's financial incentives with the customer's physical safety.
It's genius. But the modernization efforts aren't just limited to consumer-facing products like teen simulations and quoting portals, right? The earnings report detailed some serious, forward-looking moves in the back office, specifically regarding the integration of artificial intelligence.
Yes, and the deployment of AI in legacy industries like insurance is often wildly misunderstood.
How so?
Well, the broader narrative usually focuses on generative AI replacing entire workforces. But Erie's approach is highly practical, highly targeted, and entirely focused on augmenting their existing human capital. They outline the deployment of two specific, distinct AI tools: a claims subrogation AI assistant and a commercial underwriting assistant.
Let's focus on the first one because subrogation is one of those classic opaque industry terms that glazes over the eyes of a retail investor. We really need to translate both the legal definition and the financial mechanism of subrogation.
Okay, in the simplest terms, subrogation is the legal process of recovering funds when someone else is at fault.
Give me a real-world example.
Imagine you are stopped at a red light and a distracted driver rear-ends you. You are not at fault. You call Erie, your insurer, and because you want your car fixed quickly, Erie pays the auto body shop to repair your bumper immediately.
Okay, so Erie is out the money.
Exactly. However, Erie knows that the other driver's insurance company should actually be paying for the damage because the other driver caused the accident. Subrogation is the behind-the-scenes legal wrestling match, where Erie aggressively goes after the at-fault driver's insurance company to recoup the money they just laid out on your behalf.
I imagine that is a massive, complex logistical undertaking. It involves procuring and analyzing police reports, taking witness statements, reviewing medical records, and engaging in protracted negotiations between corporate legal departments.
That's a huge headache.
Yeah.
And from a financial perspective, the speed at which a company executes subrogation is critical to their capital liquidity. When Erie pays for your bumper, that money is gone from their accounts. Furthermore, until the subrogation process is complete and the other company reimburses them, they often have to hold capital in reserve against the incident.
Oh, wow.
That is liquid cash that is tied up in bureaucratic limbo. It cannot be used to pay dividends, and it cannot be invested in the bond market to generate the yield we discussed earlier.
So a slow subrogation process is a massive drag on the balance sheet.
Precisely. Which is why the claims subrogation AI assistant is so valuable. Management detailed that this tool evaluates incoming claims to identify subrogation opportunities instantly. It automatically prepares the necessary referrals, summarizes the complex, unstructured data hidden in police reports and adjuster notes, and provides the human claims handler with a streamlined package to support their negotiations with the rival insurance company.
So it accelerates the timeline from months to days.
Exactly.
And by speeding up the recovery of those funds, the AI is literally freeing up trapped capital, bringing cash back onto the balance sheet faster so it can be deployed into yield-generating investments.
And the commercial underwriting assistant performs a very similar function on the front end of the business.
How does that one work?
Commercial insurance policies covering factories, vehicle fleets, or large retail operations are incredibly complex. Evaluating the risk involves parsing hundreds of pages of financial documents, safety protocols, and building inspections.
The AI assistant steps into that workflow and acts as a sophisticated data parser.
Right. It reviews the massive influx of unstructured information, immediately flags missing documentation, and highlights the 3 or 4 critical risk factors buried on page 200 of the safety report.
Management did not provide specific, forward-looking numerical guidance on exactly how many millions of dollars these AI tools will save in administrative overhead, did they?
No specific numerical guidance yet. But the qualitative guidance, the philosophy behind the deployment, is crystal clear. The objective is not to automate the underwriting process entirely or fire their senior experts. The objective is to eliminate the tedious manual data gathering phase of the job.
If a highly paid commercial underwriter is spending 80% of their workday just reading through 300-page PDF documents to find the relevant data points, and only 20% of their day actually utilizing their expertise to make a judgment call on the risk, that is a massive misallocation of human capital.
Couldn't agree more.
If the AI can instantly summarize the documents and highlight the risks, that underwriter can spend 100% of their day making high-level, profitable decisions. They can process more complex policies with greater accuracy in less time. It is a massive lever for operational efficiency and margin expansion.
So when you synthesize all of these elements, you see a complete strategic roadmap. We have the headline numbers demonstrating solid bottom-line growth. We have the narrative behind the numbers revealing a disciplined, intentional pivot toward profitability, willingly shedding risky policies, implementing necessary rate hikes, and vastly improving the combined ratio despite absorbing the worst weather events in the company's history.
And finally, we have the technological blueprint for future growth.
Right. Hyper-segmented pricing via Erie Secure Auto, friction-free digital intake portals slashing acquisition costs, behavioral economics driving the Team Smart program, and practical AI deployments unlocking trapped capital and augmenting human expertise.
All the pieces are on the board, the mechanics have been thoroughly unpacked, and the overarching strategy is totally clear. Now it is time to deliver the verdict for the retail investor tuning in today. How do we translate this hour of analysis into actionable intelligence?
That's the million-dollar question.
I will take a firm, opinionated stance right out of the gate. Looking at the totality of this data, the Q2 earnings report from Erie Indemnity is a strongly, aggressively bullish signal for margin expansion, operational discipline, and capital stability.
I agree completely.
If you are an investor who prioritizes a management team that knows exactly how to protect the bottom line during macroeconomic turbulence, this report is a masterclass. However, it is an equally bearish signal if you are a growth chaser looking for aggressive top-line market share expansion. Management is telling you out loud and in the data that they do not care about being the biggest player in the room. They care exclusively about being the most profitable.
I completely agree with that assessment. To distill this into a highly actionable takeaway for you, the listener, if you are evaluating Erie stock for a potential purchase, or if it is currently sitting in your portfolio, you must understand its role. You hold this asset for defensive stability and reliable income generation. It acts as the ballast in your portfolio.
And the dividend proves it.
Exactly. The fact that they possess the financial strength to pay out $136 million in dividends in just the first 6 months of the year is undeniable proof of their commitment to returning capital to shareholders. Companies that are frantically burning cash to subsidize unprofitable customer acquisition simply cannot maintain that kind of dividend payout.
And what I find most remarkable about this entire turnaround, and perhaps the most crucial data point validating their long-term viability, is that they pulled off this aggressive pivot without destroying their brand equity.
Which is incredibly hard to do.
Yeah. They raised the cover charge at the nightclub by nearly 7%. They pushed 2% of their customers out the door, and they instituted stricter underwriting standards, all of which usually generate massive consumer backlash.
And yet, management proudly opened the earnings call by highlighting that Erie Insurance just ranked highest in customer satisfaction among large auto insurers in the J.D. Power 2026 U.S. Insurance Shopping Study.
That is the third consecutive year they have secured the #1 spot.
It's wild. Consider the psychological friction of that achievement. We are operating in a highly inflationary environment where consumers are absolutely exhausted by rising costs.
Yes, everyone is feeling it.
Erie's actively raising prices on their policyholders, yet those same policyholders are participating in national surveys and ranking them #1 for the, quote, process, price transparency, distribution channel experience, and policy offerings.
It basically defies conventional logic. Usually when an insurance company raises rates, their net promoter score craters and social media sentiment turns highly toxic. The fact that Erie maintained the top ranking through a period of aggressive pricing adequacy proves that their brand moat is incredibly deep and entirely intact. It speaks volumes about the quality of their independent agency network and the high-touch, localized service those agents provide.
That's the key.
When a local agent can sit down with a family, explain exactly why the premium went up, and offer them a solution like the Team Smart simulation to bring the cost back down, it neutralizes the frustration. When you combine a fiercely loyal customer base with a management team executing ruthless operational discipline, you end up with a highly compelling, deeply resilient defensive asset.
The J.D. Power ranking validates the entire strategy. It proves that consumers are actually willing to pay a premium price if they trust the product and the people selling it.
So to summarize the thesis for you, the retail investor navigating a volatile market. You buy and hold this stock because the executive team is acting like responsible, rational adults.
A rare treat these days.
Truly. They possess the rare fortitude to look Wall Street analysts in the eye and say, yes, we intentionally let our total policy count drop by 2% this quarter. It was deliberate, and we would gladly do it again tomorrow if it means getting the underlying risk pool back to structural profitability.
They are completely immune to the allure of vanity metrics.
They're hunting for pure margin. And in a macroeconomic landscape defined by uncertainty, inflation, and tech bubble valuations, that level of adult supervision and capital discipline is exactly what you want anchoring your portfolio.
It truly is a masterclass in the unglamorous but highly lucrative art of disciplined underwriting. But looking past the immediate quarter, the extensive discussion we had regarding their push into technology, particularly the aggressive deployment of AI for subrogation and risk evaluation, raises a fascinating, almost existential question about the long-term horizon of this entire industry.
The long-term horizon, where is your analysis pointing?
Well, currently, management is highly focused on utilizing artificial intelligence and telematics to perfectly evaluate risk. They want to know exactly how likely a driver is to crash, and they want to process the subsequent claims with algorithmic efficiency.
Which makes total sense for them right now.
Right now, in 2026, possessing those tools gives Erie a massive competitive edge. But let's extrapolate this technological curve out 5, 10, or 15 years. What happens to the fundamental business model if every insurance company eventually deploys AI to predict human risk with near-perfect accuracy?
Oh, wow. That cuts to the absolute core of the industry. The entire concept of insurance, since its inception, has been based on pooling unknowns. You have a pool of 1,000 drivers paying premiums. The actuaries know that mathematically 5 of them will crash this year, but they do not know which 5.
Exactly. There is an inherent lack of visibility. So everybody pays a relatively small amount to cover the unfortunate, unpredictable few.
And the massive profit margins generated by the insurance industry over the last century were entirely built on the arbitrage of that uncertainty. The insurance company possessed slightly better data and slightly better math than the consumer, allowing them to price the unknown profitably.
But what happens when the unknown ceases to exist? If AI, combined with real-time telematics, biometric sensors, and hyper-segmented behavioral data, becomes so advanced that an algorithm can look at a specific driver and say, we know with 99.9% certainty that based on your micro-habits, your route data, and your vehicle diagnostics, you will experience a $4,000 collision next Tuesday. Does the traditional concept of an insurance risk pool simply break?
If there are no longer any unknowns left to pool together, then the fundamental nature of the transaction changes entirely. It is no longer a shared risk pool shielding you from unpredictable catastrophe. If the risk is perfectly known and modeled, paying an insurance premium just becomes a mandatory subscription plan to finance your own inevitable, mathematically guaranteed maintenance costs.
Exactly. If the element of risk is perfectly eradicated by technology, does the insurance industry transform into a low-margin tech utility? Do the massive financial fortresses we see today eventually get reduced to simple, frictionless payment processors, permanently wiping out the fat, lucrative profit margins generated by historical uncertainty?
That is a staggering conceptual shift to consider. If technology eventually eliminates the risk, does the market simultaneously eliminate the financial reward for the insurer? It is a fascinating, potentially disruptive thought for all of you to evaluate as you consider the long-term, multi-decade horizon of your financial sector holdings. But for today, operating in the realities of 2026, it is abundantly clear that Erie's strategy of abandoning the all-you-can-eat volume buffet to order a highly profitable, perfectly measured steak is serving the company and its shareholders incredibly well.
It definitely is.
Thank you all for joining us for this extensive, data-driven analysis of the market. We hope this deep dive provided you with the clear context and actionable intelligence you need to navigate your portfolio with absolute confidence. Keep asking the hard questions, continue looking past the vanity of the headline numbers to understand the mechanics underneath, and we will catch you on the next deep dive.